Hey guys, it's that Dividend guy coming at you with another Motley Fool list. Today, we are covering two stocks to buy with dividends yielding more than 3%. So, first of all, I want to talk about what chasing yield is because that's very important here. So, a lot of times new investors get caught up in the actual yield that a stock pays, which is how much in dividends you're going to get per year. So, like if you see a 3% dividend yield, that means that they're going to pay you 3%. Every dollar that you give them gives you 3%, which makes sense, right? But a lot of people go and they do what's called yield chasing. And what that is they see a double digit yield, like a 9, 10, 15% dividend, um, and they put their money in that thinking, okay, well, if the overall market is paying, say, 10% a year, um, and this stock is yielding 12%, well, then I'm going to be at least matching the market. That's not necessarily true because most of the time what happens is what's called a yield trap. So these stocks will go ahead and say they're paying a dividend of 10%. But really, the underlying business can't afford to pay you that much. So, what really happens with these stocks is they trap you because you're thinking you're getting a 10% return, and by the quote dividend, you are. But the problem is that stock price is going down so much and it keeps going down because people are selling out of the stock. Which, when you have a quality business, that's a good thing. You want the quality business, like say Johnson and Johnson, Procter and Gamble, some Walmart, just some names to throw out there, these big blue chip companies. That's okay when they drop. If bad news hits or something like that, or maybe they missed earnings, that's okay because they have the product and sales and stuff, to the revenues to be generating that dividend income. The problem with these high yielders though is that they don't have that cash flow to cover that 10% dividend. So what happens is those stocks plummet, that yield goes way up, and dividend investors think that they're getting a good deal on a 10% yield when really they're actually losing money. Their money's decaying in that stock and they're not beating inflation. They're actually losing money because it's slowly deteriorating every dollar that they put into that stock. So that's one issue that some investors have, is they think that they're getting a good deal on a dividend paying stock when really it's just a yield trap. Next, the other thing is a stock that pays a really small dividend, like say 1.7 to like 2%. The issue with that is they're not paying you a lot in dividends, so you're really losing money to inflation unless that dividend, that's say 2%, is growing at like a 10% clip or something like that, or is growing like 5 to 7%, like say McDonald's or something. That makes sense because that's a mature company that's paying you more every single year. So a lot of people are like, oh, 3% isn't a lot. Well, if the 3% dividend is actually growing year over year at a decent rate where it beats inflation, that's fine. But you don't want to yield chase because that's where you actually lose money. So that's both sides of the same coin. Is you want that dividend to beat inflation, but you don't want it to be so high that it actually deteriorates the money inside the stock. So, just wanted to go over that real quick because I know a lot of people that I actually talked to on Instagram and who I've talked to on YouTube. They see like an AT&T dividend yielding 7 or 8%, and they're wondering why don't a lot of people own that stock? Well, that's because AT&T couldn't actually they didn't have the cash flow to keep raising that dividend, amongst they sold off some assets and a part of their business. But that does happen a lot, and the thing is, people get screwed over because they see that big yield, and when something like a market correction, coronavirus, oil issues, trade issues, something like that, election comes around, those 10% yields just get cut because there's fluctuation in the market. So I just don't want newer investors to look at a 3% yield and think, okay, that's not really enough money. That doesn't beat inflation. If inflation's 5%, but we're focused more on not necessarily the yield, but how much that dividend is growing over time. Because over time, that yield will go up. But don't let that fool you. A lot of dividend growth stocks are sitting in that 2.5 to 3% range, growing pretty consistently. Just don't get caught up in a yield. So with that being said, guys, let's take a look at these two stocks to buy with dividends yielding more than 3%. So year over year inflation is about, say, 3%. So these will beat inflation. Plus, that's where they're currently at. As they grow, they'll outpace inflation. So first off, we've got Pfizer, which I just sold because I felt like it was overvalued due to the good coronavirus vaccine news. But Pfizer has become a household name in recent months because of its highly successful coronavirus vaccine partnership with BioNTech. But the company was already a pharmaceutical giant before the pandemic, and it has a solid track record of paying and raising its shareholder dividends. At the time of this writing, the dividend stock yields an attractive 3.2%, trading at less than $50 per share and around 21 times trailing earnings. Pfizer is also one of the most affordable healthcare stocks for long-term investors. It has seen remarkable balance sheet growth over the past few quarters, stemming from the revenue generated from the COVID vaccine. And the company also has an exceptional lineup of top-selling drugs and vaccines that continue to rake in substantial profits. The spin-off is wildly underperforming. Generics unit Upjohn with Mylan to form Viatris late last year has essentially breathed new life into its balance sheet by allowing the company to focus on its first love, its pharmaceutical business. Sales of commentary excluded. Pfizer's second quarter revenue increased 10% operationally from a year ago's quarter. The healthy growth was driven from a range of factors, including double-digit revenue increases in its oncology, hospital, and rare disease drug segments, continued high demand for blockbuster drugs like blood thinner Eliquis and Ventquil and Vindamax, which treats I'm going to try that, and 88% year-over-year revenue growth from its biosimilars products. If you factor in the commentary, revenue increased by a considerably higher rate of 86% operationally from a year ago. It's slated to bring in $33.5 billion in sales this year. Pfizer and BioNTech also have multiple supply deals stretching out over the next few years. Given the rise in the new coronavirus variants globally, along with the strong possibility that more stockpiles of commentary will be needed by nations around the world to cover the much anticipated third booster shot, the vaccine is likely to be a long-term source of revenue growth. Pfizer raised its year guidance in its most recent quarterly report and is expected to generate between $78 billion and $80 billion in revenue during the 12-month period. To offer context, the company generated revenue just shy of $42 billion in 2020. As one of the world's largest pharmaceutical companies with an established lineup of high-performing businesses and healthy trajectory from growth ahead, not to mention its sweet dividend, Pfizer is an attractive stock for traders of all investing styles and ages. Next, we have Verizon. Ticker symbol VZ, dividends even higher than Pfizer's, yielding 4.5% at the time of this writing, and the company is one of the three largest wireless carriers in the U.S. with fellow telecommunications giants AT&T and T-Mobile. 2020 was a mixed year for Verizon's businesses and its balance sheet as the pandemic drove a decline in the demand for the products and services. The good news is the company's reported strong year-over-year growth in both the first and second quarters of 2021, signaling a robust recovery from any lags at the height of the pandemic. Verizon delivered an increased consolidated operating revenue, 4% in the first quarter and 11% in the second quarter. It also generated year-over-year revenue increases in its consumer businesses and media segments of 5%, 1%, and 10% respectively in the first quarter. That is followed by spikes of 11%, 4%, and 50% respectively in the second quarter. Total wireless services revenue jumped 2% in the first quarter and 6% in the second quarter versus a year ago. The stock isn't known for rapid growth, rapid price gains, or lightning-fast balance sheet growth, but Verizon is a quintessential value stock and one of Warren Buffett's favorite in the tech industry due to its consistent shareholder dividends. Trading around 12 times trailing earnings at less than $60 a share, the stock is a remarkably attractive valuation to boot. Verizon's substantial market presence and its record of gradual balance sheet increases, coupled with an attractive dividend, make the stock one to buy and hold. Investors can rely on for sustained portfolio growth for years to come. So guys, let me know what you guys feel about these two stocks. I think they're both they're both phenomenal stocks and great growing industries. Pfizer, with that COVID shot, is going to see insanely big revenues, and Verizon is one of the biggest players when it comes to 5G and did a lot of investing into the 5G infrastructure. So both of these are phenomenal companies. Let me know which one of these two or both that you own, or maybe a competitor. Maybe you own AbbVie or maybe you own T-Mobile. Let me know down in the comments below. Thank you guys so much for watching. Remember to hit the subscribe button. And when you do hit the bell notification, guys, remember, it is not about yield chasing. It's about the quality companies that are going to pay us for years to come. And I do think both Pfizer and Verizon are very good quality companies. Thank you so much for watching, and I'll see you guys in the next video. Take care.